in dollar protection and inflation protection investments. Ray Randa put together the following slides, and it talks about the contributions that dividends have made to total returns over the course of various periods of time. And it's interesting to point out that according to Standard & Poor's, 35% of the return of the Standard & Poor's index between 1926 and 2008 was accounted for by dividends. Citigroup did it for 100 years, and almost 50% of the return of the S&P 500 has come over that 100-year period of time from dividends. Over the last 3, 5, 10, and 15-year periods of time, dividend growers have in fact outperformed the basic S&P 500. Now we all know that there are periods of time when this isn't going to happen, and there are prime periods of time like March of last year to the end of, until today in fact, where that has not been the case, certainly the late 90s. Any roaring bull market period of time, and these big multinational dividends with betas less than 1 in most cases do not outperform the S&P 500. But we think we're entering the part of the cycle now where they in fact will. Ray goes on to point out in this presentation that the typical dividend-paying stock has a risk that's lower than the typical S&P 500 stock. It has a beta of oftentimes less than 1. And these next pages, Ray put together a chart of some companies that have regularly increased their dividends, and the names that we might use in the portfolio. We don't use them all, but these are the kinds of names that we might use. And I think you might find it interesting to note that between 2006 and 2009, a very tough period for most companies, these companies increased their dividend. As an example, Procter & Gamble increased its dividend by 42% during this very tough period of time. Procter & Gamble has increased its dividend every year for 55 years. That's astounding. And the beta of Procter & Gamble, along with lots of many of these other companies, is less than the beta of the S&P 500. That isn't always the case. Here's Lowe's as an example that has a higher beta. But going forward, if the market is going to go sideways or maybe correct a little bit, but not roar up, these lower beta companies with high dividends and a good history of increasing those dividends, we think will be the kinds of companies that will perform the best and give you the best total return. Here's some more names on this page, and here's an example of a number of names, some of which are on the previous pages and so forth, that we would typically use as some of our favorite large cap dividend payers. They're all household names, all international type names. If I can now, to move from the 2010 portfolio, I'd like to take just a minute and talk about, well, let me summarize first of all. So we're going to buy multinational companies that pay solid dividends and have a history of regularly increasing those dividends. That's 50% of the portfolio. We're going to include commodities designed to protect against inflation. Examples of those commodities would be copper. We're going to be investing part of the portfolio in the faster growing and less indebted emerging market countries, and that's it can be South Korea, it can be Mexico, it can be India, it can be China. We're going to invest in some currencies of commodity-rich countries to protect against a declining dollar, and the prime examples of that would be the Australian dollar and the Canadian dollar. And finally, once again, the initial balance of the portfolio is 50% in U.S. dividend payers and 50% in the dollar protection, inflation protection, and international growth portfolios. Let's talk a second about the fixed income markets and update. And what's on the screen now is the various yield curves as of yesterday, I guess, or as of 4:15. And there are some things just in general that stick out here. First of all, the front end of the curve, these are yields on this axis. But no matter what you're in the short maturities, and this is out to 2014, no matter what the bond, you have a 1 or maybe a 2% handle, very low interest rates. We all, and I know that you have the problem of, as well as we, of what you can invest people in that gives them some yield. I want you to notice on here a line that we've added, over the course of the last year, I think you're probably all aware that the Build America Bond Program and the California Build America Bond Program in particular, and that's this line. And there are a couple things to note. First of all, it's single A rated, taxable. It's taxable at the federal level, tax-free at the state level. These are the blue line here are single A corporate bonds. There's a big spread between corporate bonds and the Build America Bond Program, and yet they have the same rating. The typical corporate bond buyer is not used to analyzing state of California's credit or other Build America bond issuers' credits, and as a result, from an investor point of view, the Build America bonds are attractive. They're also attractive from an issuer point of view. If 35% of the interest is paid by the federal government, the cost for the state of California, as an example, to issue bonds here at that yield is cheaper than issuing, and this is the state of California curve, the triangles, is cheaper than issuing bonds here. So that minus 35% subsidy drops them down to a net cost somewhere in here. The last issues that came, state of California saved on the long end about 80 basis points a year ago, when in March and April when they first came to market, they actually saved about 110 basis points. There's an aberration in the market that shouldn't exist. This should not be that much cheaper than corporate bonds. State of California should not be able to borrow in this market and still have a lower cost than if they would borrow in the municipal bond market. Their cost is actually down here. That all doesn't make sense. This is something that will get straightened out. I think the value in the market, in the corporate market, is these Build America bonds in the taxable market. These spreads will narrow. You also note that on this page of the yield curve being very, very steep. And in order to get any yield, you need to go out and buy longer maturity bonds. And of course, one of the questions and one of the things that Eric pointed out at the beginning of this call was the concern about owning longer bonds. So let's take a look and see if we can make any sense about buying something longer on the curve and what the risk may or may not be in doing that, where you can go out and pick up some yield. On this particular graph, this is municipal bonds, and what we're going to do is go back and look at times in the past and look at real Treasury yields, real municipal yields, compare them with today's market, and then see if it might make sense to position yourself in the longer end of the yield curve, or where to position yourself for that matter. So what this is this line, the squares that are hollow, is today's Treasury curve. The triangles is today's California general obligation municipal bond curve. The red squares at the top is what the Treasury curve looked like on June 28th, 2007, June 30th, essentially 2007. The blue line is the municipal bond curve in June of 2007. Now, June of 2007 was a strong market. We had a strong economy. We had low inflation, and yet you see that the yield curves are substantially different in shape, and what may surprise you is that yields on California general obligation bonds actually cross and become higher yields at about the 10-year part of the curve than they were in a strong market in 2007. So if you believe, or if you think there's a possibility that inflation won't get out of control, or that there, in fact, will be a lack of supply of muni bonds because of higher tax rates, because the Build America Bond Program is taking 30% of the issuance, that you actually might be able to make money by buying longer-term California bonds and having the yields go down to levels that we saw just 3 years ago. Now, the yellow dots give you the total rate of return potential over a 3-year period of time, and this scale on the right-hand side gives you those numbers. Well, just in general, this goes straight up, and the longer out the yield curve that you go, the better your return would be if we go to a 2007 type environment. This is not our base case. We think you'll have higher inflation and possibly higher yields in this, but this is a very real example of what can happen in a strong economy, and it's certainly one of the possibilities. Let's look at another one. In this case, we're going back to 1994. A couple peaks in interest rates. One occurred in 1994, another one occurred in 1999 when rates didn't get quite as high, and then you have to go back to the late 70s, early 80s before you get really high inflation and high interest rates. But in 1994, we got to pretty high interest rates. We had treasuries, which is this top line, at approximately 8% from, say, 10 years on out. And this, again, the treasury curve today is way down here. So you've got a long way to go from today's levels to get to a comparable level in 1994. The same blue line is that you saw on the last one is the 1994 municipal bond curve, the California general obligation curve in 1994. And this triangle line is the California general obligation bond curve today. So if we go, and it takes 3 years to go from this curve to this curve, and interest rates when treasuries go to 8%, a bond at 16 years becomes a 13-year bond. I'll draw that a little bit better. So you're moving from here to here over a 3-year period of time. What would your total return be? The total return would be that yellow dot over on this scale, so somewhere around 8.5% total return, and that includes a decline in the principal amount of the bond, but the combination of income and principal. What this tells you is that you might feel safe. The previous curve, previous slide said the further out you go, the more money you're going to make in the bonds, and that's kind of counterintuitive. But this one also tells you that there's a spot on the curve, in particular in California general obligation bonds, that you might want to put some of your money, and that's essentially from 10 to 20 years, give or take, and yields from a little over 4% to a little over 5%. So between 4 and 5%, that even in a rising interest rate environment, you might be comfortable putting some of your bonds. The other part of your portfolio, maybe you want to barbell it and make it short. You don't want to put all your eggs in one basket. But as opposed to, as an example, a straight laddered portfolio going out whatever period of years, this would be a more barbelled approach to investing. And if our math is right and the curves look like this, even in a rising interest rate environment, a barbelled approach today is probably what you'd want to do. Let's look at corporate bonds. This tells a completely different story. It tells you how rich corporate bonds are in the marketplace. And this is, again, going back to 1994 type levels. Here's the same treasury curve at 8%. The black line here is today's corporate curve. But all you got to do is look at the yellow dots, and it tells you, and these are actually negative numbers, it tells you how rich corporate bonds in general are today. And if you're going to have a corporate bond portfolio, you better be careful about where you are in your maturity list. Now, if you do Build America bonds, some of these dots do pick up a little bit. You have a few dots up in here maybe, and frankly at the long end you'll get a dot or two out in here. So there may be some value in the Build America bonds because of the extra yield, but in general this tells you that corporate bonds are very overpriced, and so you ought to be careful.